Welcome to the Daily Update, where I'll go over the action in the market for Wednesday, August 30th, and then we'll see how things are looking for Thursday, August 31st, last day of the month. Not the end of the quarter, so there might not be a lot of shoring up, but there are folks that do things on a month-by-month basis. We had another up day. We just kind of went up right after the open and just sat there for the rest of the day. It's turning things back even more positive. In fact, we can actually take a positive stance now. You had a lot of pessimism that was in the market, and the market has a tendency to do the opposite of that. It looked like maybe it was going to wait until next week before this got dealt with. Well, it turns out it's being dealt with this week. We're still below average with volume, and we'll have to see, are things going to shift as we come back after the long weekend coming up? Before I get started, please know that on Monday, September 4th, which is Labor Day, I will be doing a 3-hour course. I'll be going through some different topics. I'll talk about my approach to technical analysis. I'll also be talking about some strategies as well as support and resistance. I plan on spending about an hour on each topic. I also plan to stream this on YouTube and Rumble, but if I run into any problems with that, I'll be using Zoom as a backup. Before we start with this class, I'll make sure that on the community tab on the YouTube channel, that there's a link to my Zoom account in case we need to jump over and use that. If you can't make it, don't worry about it. I do plan on recording. Also, if nobody shows up, I'll just hit the record button and start talking as though I'm talking to lots of people, kind of like what I'm doing right now. So keep that in mind if that's something that you want to partake in. Also, the following week, I'll be doing the same class, but I'm going to separate it into 1-hour segments spanning over 3 days instead of doing everything right in one day. Let's go back and talk about what happened. Right at the open, we had a higher open, not much of a gap, but prices rose up to R1 at 45.21. Then we fell back to the unchanged level, which is a built-in support on an up day. There wasn't really much of a gap to fill, but to see this kind of price action is not uncommon. Then as the day went on, we got back up to R1 and we drifted sideways kind of below R1 for most of the day. We closed near the high and we were back above 4,500. So that is positive. We were up 0.38% on below average volume. That continues. The technicals are turning more positive. In the short term, you can make a case that we're overbought. There's still more room to run on our indicators, and I'll show you these to kind of tell you what I'm talking about. And we're pretty much more positive now in the intermediate term, and we're still positive in the long term, but we have to be kind of careful. A lot of this rise was done on below average volume, but we've been seeing that for quite a while now. Sometimes because of September starting and vacations being over and school starting, the folks come back from their summer mindset into their fall mindset, and that could take things in a different direction. So we'll have to see how that plays out. What are some comments that we can make? The mega caps, which have been real leaders all along, as well as growth stocks, had a good day, and this helped the S&P to close above 4,500. We also had weaker than expected economic reports. This also gave support. We're still kind of working through that scenario that bad news is good news. We had GDP come out that I'll talk about. We had some other economic reports, and these were all weaker than expected. That also pushed interest rates down, which gave support to stocks. Growth did outperform value. And then this current scenario, which we're wondering, is it going to morph or shift into some kind of a new scenario? We're still kind of going with this one right now, that the economy is stronger than expected. Okay, that was making things more negative. But as these reports are coming out, they're coming in weaker than expected. So that's turning things back a little bit more positive. And that the Fed will have to keep rates higher for longer and possibly even raise rates. Now that's even starting to be questioned as of right now, but that could shift at any time. And then I just saw a headline right before I started recording that there's some more weakness coming out of China as far as what's happening with them economically. On a short-term basis, we have a new addition. The CMB composite is now looking extreme positive. the Stoke RSI, which has been there, the Williams percent R. We also had the CCI 20 added to the 14. That's a new addition, and our stochastics. And I'll show you all of these charts. The dollar was down and interest rates were down. That also gave support. All of the yield curves that we follow are still inverted. Sentiment remains neutral. It ticked up to 51 where it had been at 50. Our trend really hasn't changed all that much. The green line did go above the red line yesterday. Well, it's continuing to go above today, but the ADX really isn't moving yet. So in the intermediate term and the short term, we're still below 20, suggesting we're in a trendless environment. And both the ADX lines on each chart, the short and intermediate term, they're below their moving average. Our bias continues to be positive and our momentum is positive. We've had 4 days in a row with positive closes. Economic reports that came out. We had the weekly MBA mortgage applications index. It was up 2.3%. Last week, it was down 4.2%. The ADP employment change, and this was kind of the biggie. It came in weaker than expected. They thought it was going to be 195,000 jobs. It came in at 177,000 jobs. It's also down from the 371,000 that we saw last time. The advanced international trade in goods was at a minus 91.2, up from the minus 88.8 that we saw last time. Advanced retail inventories were up 0.3%, less than the 0.5% they had expected. Wholesale inventories were down 0.1%, stronger than the down 0.7% that we saw last time. The second quarter GDP, this is another reason that we're seeing bad news is good news. The estimate for the GDP actually has come down. Last time it came in at 2.4%. Now it's down to 2.1%. It's still positive, but it's down from where we saw it before. The GDP deflator, second estimate, it came in down a little bit more than expected at 2%, where last time it came out at 2.2%. Pending home sales were up 0.9%. They expected them to be down 1.3%. Last time they were up 0.4%. Here's the mortgage applications index, just showing the overall figure for the week and how they had advanced. Here's the ADP employment change, where we're still seeing a lot of jobs out there, and there's still plenty of jobs to be had, but we are really trailing off with these jobs. So even though it's positive, we are declining, and this right now is using that bad news is good news scenario to justify prices going higher. Sorry about that, clearing my throat. Here is the updated chart for the GDP. That's the blue line, where it's still above zero. So that's one of the definitions of a recession, is when we drop below zero for 2 quarters in a row. We're still positive right now, and we're seeing the deflator, which is the orange line. It's continuing to decrease as well. Here is the personal consumption year over year, still positive, but is declining. And then looking at and I have to move this around a little bit. You don't see this, but there's a big bar in front of me where I can't always see the top of the chart. The net exports ended up being flat overall. So taken together, the market was pleased by this report that it was still okay, but not too strong. It was more Goldilocks. All right. And looking at the next chart, the real GDP, that means inflation is taken into account, does show us going up a little bit here, but not as much as they had expected, and not as much as it came in last time. Then pending home sales were up 0.9% overall. And then we're looking at this chart, which is the VIX, taking an average from 1990 to 2022. That's the blue line. And if we follow that, which is what we've been doing so far with the red line, that would mean that stocks would go down because the VIX goes up when stocks go down. We could break away from this at any time, or we could continue to follow it. We just use this as a guide just to give us an idea of what has happened in the past, kind of like the Stock Traders Almanac statistics. Then put out by Real Investment Advice, forward earnings estimates are getting very optimistic. Here's where we're at right now, where we are seeing a bounce up with the earnings estimates. And then going forward, they just have us continuing to go up and up and up as we go from actual earnings into forecast earnings going forward. And this also justifies prices going higher. Then we have the economic surprise index, where it had been going up, but now it's starting to come down as we've been getting some weaker than expected economic reports. We also have the latest reading of the Investors Intelligence Survey, where it had become a little bit extreme positive, and now it's really starting to drop lower, as a lot of folks were just expecting things to continue to fall. Here's the intraday chart where we did have a higher open. We didn't have a gap, but we came up to R1, came back down to the unchanged level, and then drifted back up to R1, drifted a little bit lower, drifted a little bit higher, and we closed below R1, but near the highs for the day. Looking at growth versus value, growth is hanging in there pretty good. The green line's on top and outperforming the red line, which is value. Looking at the growth to value ratio for the S&P, we're above the unchanged level, showing that growth had a good, strong upward move right after the open, and it was able to hang on to those gains as the day unfolded. So that's positive also. The VIX continues to fall on the line chart and the bar chart as we've been going higher. And volatility, the VIX of the VIX continues to show that volatility is dropping off. Now, this might get to a pretty low level, and people might be able to form a sense of complacency, and then something happens in the market and they suddenly start to freak out again. So we always want to be aware of that. Looking at our 5-period simple moving average of the equity put call ratio, after spiking up, coming down, now we were going back up. We're finally starting to roll over with this moving average now. That could be more positive for stocks. Here's a longer term look at that same chart. After giving us an extreme reading, it declined, went back up, and now it's starting to decline again. The VIX to VVIX ratio, this is still a concern, where when this was going down, that was positive for stocks. Now it continues to turn up, and it's going to take a while for this thing to shift. And looking at our long-term equity put call ratio based on 253 periods, we were declining, and that gave good support, but now we continue to go up. This is another one of those indicators that can take a long time to turn. Looking at our ratio versus risk on versus risk off, we are seeing just a little bit of an improvement. We had been going up as stocks were going up. We fell back more in the short term as we were experiencing the month of August, and now we're seeing a bit of an improvement with this ratio. Here's one of the indicators that are overbought, the Stochh RSI, giving us an extreme positive reading. Now, it can stay here for a while, and if we continue to go up, it'll just paint in some of these blue areas and just continue to go sideways. Also, the Williams percent R, which was just barely extreme positive yesterday, has now gone more extreme. Again, it can camp up here for quite a while. There's two ways to look at this, that we're overbought and due for a pullback, or that we're seeing some pretty good momentum here, and so that's more positive. The CCI 14 is extreme positive, and the CCI 20 just barely above 100 here. So both of these indicators still have more room to run to the upside if that's what happens. Looking at the condition of our trend, the ADX is still below its moving average and below 20. That suggests a trendless environment, trying to turn back up, but it could take a few days for this to really turn up and get going as the ADX tries to figure out whether we're trending or not. We would default to the positive because the green line is on top and advancing. And we're seeing pretty much that same thing with our short-term ADX. Trying to turn up, but still below the moving average. Green line is on top. Both are below 20, meaning the ADX and the moving average. So that suggests a trendless environment. Looking at the daily chart, we were able to get above the 50-period simple moving average, and that's positive. We got above this pivot level. Now we're running into another pivot level right here, which currently is acting as overhead resistance. On the bottom, we still see where volume is below average. Looking at the stochastics, becoming extreme positive in the short term, turning more positive in the intermediate term, and also looking better in the long term. Looking at our 20-period double and triple exponential moving averages. Haven't shown these for a while. We price dropped below both of these, and I always have to look at this. The green line dropped below the blue line as we were going down. We're starting to get above both of these lines, and if the green line crosses back above the blue line, that would turn things more positive in the short term. Here's a further outlook based on 50 periods. I pointed out yesterday that maybe this blue line was acting as overhead resistance. Well, now we've been able to break above that and close above that. So this is looking more positive. If we continue to go up, we'll want to see the red line come back above the blue line. Our highest high, lowest low values. We're starting to go sideways with our lowest low values after we were able to get above the midpoint. We haven't really started to turn up with our highest high value. That's the blue line, but we are showing some improvement here. The balance of power is now crossed back above the dash line. That's switching from negative to positive. The CMB composite is starting to give us an extreme positive reading. This is meant to be a standalone trading system. I don't use it like that. I use this like an oscillator for extreme positive or negative readings. I put these black lines on here, so there's really nothing magical about them. They're just kind of guides to tell us when maybe we've gone up a little too far, too fast. The summation index based on price is continuing to turn back up and is above zero. That's turning more positive. We're still below zero based on volume, but we were turning up before price turned up, and we're showing some improvement here. The NYSE summation index based on price and volume is starting to tick up with both of these indicators. The NASDAQ 100 bullish percent index crossed back above 50. That's turning back more positive. The Copic curve generated a signal after Monday. It's continuing to generate a signal now. The mass index, we crossed above the red dash line. We're coming up to the blue line. We're going to wait to see what happens if we fall back down with this indicator. That's when an official signal will be generated. Our advanced decline line showing improvement based on price and volume and above both of the moving averages. Seeing a bit of an expansion with the new highs and turning back up with our 5 period as well as our 10 period. The 10 period is starting to cross back above zero. We're looking better here with the advanced decline ratio, the green line and the red line, even though it's a little hard to see the red line. They're both above zero and advancing. This is also showing some improvement with accumulation distribution. What's the smart money doing? We've crossed back above this moving average. The longer we can stay above that, we'll eventually see the red moving average start to turn back up, and that would turn things even more positive. This is a new chart where I'm plotting the NYSE advanced decline line on top of the S&P 500, and then these moving averages apply to the NYSE advanced decline line, where when we were really going up, this was looking a lot more positive. In fact, earlier in 2023, we saw this outperforming the S&P. Well, when we were coming down in August, this started to underperform the S&P, and it's still underperforming right now. That just suggests that the big stocks are outperforming the smaller stocks or the broader market right now, but this is showing some improvement. And we look at the cumulative NYSE advanced decline line, also coming back above its moving average, also coming back above its moving average with the regular advanced decline line, and still kind of bumping into the underside of this trend line. We're coming back above the trend line on this other measurement of the NYSE advanced decline line. The Chaikin money flow has now turned positive. We had been seeing some improvement with the red line going up, even though it was still negative. And this tries to measure what is the smart money doing, and it looks like they're coming back in and buying. The MACD is also turning over and looking more positive. After getting negative and going below zero, it's now crossing back above its shorter term moving average. Here's a look at all of our oscillators, and I'm sorry, I can't zoom in on this, but the short-term oscillators have now turned up. We're starting to see them turn up in the intermediate term, turning up just a little bit in the long term, but have not crossed their moving averages yet. Our moving average tree study, we're above all the moving averages now, and if we can stay above this, that would turn the 20-period moving averages back up and eventually provide support the longer that we stay above them. Looking at the 20-period simple moving average of the open, high, low, close, we've been able to break above all of these lines in the mini rainbow. The longer that we can stay above this, the more likely it will be that this rainbow will start to turn back up. We also closed just barely above this intermediate term trend line. Now, please be aware, I drew the lines on here, so they're not necessarily exact. I have to kind of eyeball this. We might be right on the trend line right now, but according to what I see based on this, we're just a little bit above this intermediate term trend line. If we can stay above this and continue to go up, that would turn things more positive. We're starting to come to the upper side of the Ichimoku cloud. We camped out down in here in this green area, which was providing some support. You're never quite sure of that at the time. You can only look back a little bit in hindsight, but this is also showing some improvement. Our standard deviations, we were able to get above the midpoint. That happened yesterday. Well, we got up to the 1 standard deviation. Now we're coming into the 2 standard deviation. If we get up into the 3 area, that might suggest that we're going up too far too fast, but we haven't done that yet. The vortex is starting to turn back more positive. The green line's crossing the red line. On balance volume is crossing back above its moving average. The longer it can stay above this, the more the red line will be likely to turn up. Looking at our different charts, which are also showing some improvement. The Heiken Ashi is looking positive. The Kagi chart is looking positive with the black line pointing up. The Renko has an open block here, so that's turning positive. And the 3-line break is also looking more positive. The longer-term MACD, this is a bit of a concern. We dropped below the moving average, and we're still seeing a decline. Now, if we have a good solid week, we could always recover from this, but longer term, this is looking more negative right now until proven otherwise. Looking at the growth to value ratio, not a big breakout right here. We were up slightly. We've been pretty much going sideways since about March or so, even though we continue to be in a longer term uptrend. Dow theory, where we're looking at traditional Dow theory, where the Dow was up, the transports were up, and the utilities were slightly down. The Dow is also possibly hitting some overhead resistance now. It recaptured its 50-period moving average, but now we're bumping into this monthly pivot level. Also, could have some overhead resistance with the NASDAQ 100. We were able to break above this previous high, but is this line that's a pivot level going to produce some problems? That is what stalled things out in July, and then we started to come back down from that. We'll wonder if we're able to break through that this time. The NASDAQ 100 on a momentum basis is starting to turn back more positive. The PPO is turning up. It's still below 0, but it's starting to look better. The NASDAQ also has some overhead resistance at a pivot level. We're above the 50-period moving average and above this previous pivot level. Can we continue to go up? If we do go up, can we close above this pivot level? We're also just keeping an eye on the NASDAQ fib levels. We were able to get back above the 61.8% retracement line. The longer we can stay above that, and if we start to come down, the more likely this will provide support. So if we do continue to fall, we'll be watching that level if we, in fact, start to fall. The FANG index was finally able, for 2 days in a row now, to close above its 50-period moving average. It is in a longer-term uptrend, so this is turning more positive. The small caps also hitting overhead resistance above their 200-day moving average, coming up to this pivot point, coming up to the 50-period moving average. To get above this and close above this would turn things more positive. Looking more positive with the Russell 2000 small cap index. The RSI has crossed above 50. That's actually turning positive. We're coming up to the 50-period moving average, and the MACD is turning up and just barely starting to go positive. The mid caps are right about at this pivot point right now, a little bit above their 50-period moving average. Can we get above that and continue to go higher than this, or are they going to end up finding some kind of resistance at this level? We did see the 10-year bond yield tick down in Wednesday's session, and we're seeing a bit of an improvement based on price, where the RSI is above 50. We're still working off of a recent death cross, so that's longer-term negative. But if on the bottom, we see the MACD starting to turn positive. If we continue to go up based on the price of bonds, are one of these or both of these moving averages going to provide resistance? Then looking at Tom Bowley's research, this will be the last day that I show this because it just covers the month of August, where we're coming into a weaker time of the month based on his research. Now, other research that we look at contradicts that, suggesting that what we're seeing right now is not necessarily a surprise with the market going up. So what's our outlook for Thursday? We're still getting earnings reports that are being released. The markets will be closed on Monday for Labor Day, just to be aware of that. The technicals are positive, but we're becoming more overbought in the short term. We will be getting the weekly jobless claims, personal income and spending, and PCE prices. That's the big one, and that's what the Fed likes to use to measure inflation. We'll get the Chicago PMI, and then keeping an eye on the geopolitical events. All of these things are always in the background, but for the markets, it's about finishing your vacation, enjoying summer, having a barbecue over Labor Day, and then inflation and interest rates. At least that's how it looks right now. Here's the updated economic calendar for the week, where on Friday we will get the big employment situation report as well as the ISM manufacturing index. The Stock Traders Almanac statistics for the last day of August were neutral to positive across the board. That's taking all the years together. But when we look at the presidential cycle, we do tend to see some strength going into the end of August. Here's another look where maybe we finally got beyond this time in August, where it looks like we bottomed out and we start to go up a little bit higher with the NASDAQ. Here's the S&P, where we do see some strength going into the end of August. We will be on the 23rd and last trading day of the month, and then looking at pre-election years, where we tend to see some real positive action. When we look at the green dash line, that's the S&P, and all of the indexes are looking more positive during pre-election years. So our scenarios, not really going with the down one yet. I should have changed that over to white. You could start to look at going with the up scenario, but at the same time, we're getting oversold in the short term. We have some major economic reports coming out, and we want to see how things are going to close if you're doing any kind of directional positions. We could still lean towards the sideways trend because both of our ADX charts continue to be below 20, even though they're turning back a bit more positive. The warning signs. We're wondering now, have we finally finished with this convergence of these short-term bearish signals? The longer-term trend signals, I haven't shown those charts in a few days. We're still below those longer-term trend lines for the NASDAQ 100 and the S&P. Seasonally and historically, August tends to be weak, but we're also showing some positivity as far as seasonality during pre-election years. Is it finally starting to happen? The equity put call ratio, it's starting to spike up again and possibly beginning to roll back over. The cumulative new highs and new lows are still showing weakness. That's gone on for a long time, and it will probably continue. The 3-month yield is still above where it was back in 2007, and we're dealing with earnings season as they are released. The positive signs, we have the seasonality and setups that remain in the background. The daily special K chart is still positive. The weekly chart is still negative. The longer-term equity put call ratio has been declining, but it's now turning back up, and it has not rolled over yet. So it's positive longer term. We're just more concerned about it in the short term. The S&P is still above the downtrend channel upper line. We're still seeing a bit of an improvement with the risk on, risk off ratio after it had been weakening. The oscillators in the short and intermediate term for the S&P, they're starting to turn back up. The longer term oscillators, they're not quite positive yet, but the NASDAQ 100 oscillator that we've been following is turning positive, even though it's still below zero. The S&P is outperforming utilities, and the Staples to S&P 500 ratio is declining. The Russell, the small caps, and the mid caps are still working off of recent golden crosses. Small and mid cap growth continue to be positive. The financial sector generated a recent golden cross. The parabolic daily chart for the SAR, let me say that again. The parabolic SAR on the daily chart is still positive, and the Copic curve just generated a recent buy signal. So our conclusion, we're turning positive, but in the short term, you could make a case that we're becoming short-term overbought. And that's what happens. We were chopping around sideways. That's what was bringing our ADX indicators down. And now we shoot up and go positive, and we get this extreme positive reading very quickly. In the short term, we're positive, but looking possibly overbought. Intermediate term, we're looking more positive for right now. I want to make sure that we see some follow through in this, where long term, we still remain positive. So thank you. I really hope you found this helpful. Have a really good day, and I will talk to you in the next video.